tensions are flaring up again after China imposed even tighter export controls on rare earth minerals. The Trump administration saying it will set price floors across a range of industries to combat market manipulation by China.
China warning it is not afraid of a trade war with the U.S. after President Trump announced plans to impose 100% tariffs on Chinese imports and new export controls on critical software. However, the president also then softened his tone over the weekend, saying everything with China will be fine.
Tensions between Washington and Beijing have reignited, casting a long shadow over the global economy. China has issued a sharp warning that it is not afraid of entering a trade war with the United States, following President Trump's decision to impose 100% tariffs on Chinese imports and introduce new export controls on key software technologies. Yet within days, the president appeared to soften his tone, telling reporters that everything with China will be fine. Despite the reassurance, markets reacted nervously. Investors and diplomats alike sensed that the fragile calm between the world's two largest economies had once again been broken, and that a new, more volatile chapter was about to begin. The confrontation escalated swiftly. In retaliation for China's tightening of export controls on rare earth minerals, Washington unveiled a sweeping set of tariffs targeting nearly every major Chinese export sector. From electronics and solar panels to electric vehicles and medical devices, officials framed the move as a necessary countermeasure against Beijing's manipulation of critical markets. But beneath the surface, the policy signaled something more profound, a deliberate step toward open economic confrontation. Analysts warned that if these measures continued unchecked, they could dismantle the global trading order that has defined international relations for decades. In Beijing, the reaction was immediate and defiant. The Ministry of Commerce issued a statement vowing to defend national interests at any cost and maintain stability within global supply chains. Reports from Chinese state media suggested that officials were already preparing a powerful retaliation package, one that could target the very foundations of global manufacturing. Plans included new restrictions on the export of lithium, neodymium, and praseodymium, the essential materials that power semiconductors, electric vehicle batteries, and advanced electronics. With China controlling nearly 90% of global rare earth processing, this was not just a counterpunch. It was a clear warning that Beijing was willing to weaponize its dominance in critical minerals. Inside Washington, the implications were immediate and severe. A sudden disruption in rare earth supplies could paralyze entire industries, from Silicon Valley's tech giants to America's military contractors. Yet, according to insiders, the Trump administration saw the standoff as a historic opportunity. Senior advisors reportedly told Bloomberg Economics that this confrontation could finally reset the global industrial map, forcing companies to relocate production out of China and into new manufacturing hubs such as India, Vietnam, and Mexico. The initiative, dubbed by lawmakers as a strategy of economic encirclement, aimed to weaken Beijing's reach and restore U.S. dominance in global production networks. For China, however, Washington's actions were viewed as a form of economic aggression, an effort to destabilize its long-term growth. According to reports from Nikkei Asia, government think tanks presented President Xi Jinping with three counter-strategies. The first, gradually offload U.S. Treasury holdings, now exceeding $770 billion. The second, restrict exports of advanced components used in American defense and aerospace sectors. And the third, escalate military activity in the South China Sea, including live-fire exercises near Taiwan and Guam. Western analysts describe these combined moves as an emerging economic blitz, marking the first time Beijing appeared willing to merge financial, military, and diplomatic power in a coordinated challenge to the West. Concern grew rapidly within Washington. Intelligence assessments warned that America's stockpiles of rare earth metals could sustain semiconductor production for less than 7 months if China imposed an export ban. Despite the grim outlook, Trump's administration pressed forward, announcing a $400 billion national program to secure technological independence. Plans included massive new semiconductor facilities in Arizona and Ohio, expansion of rare metal mining in Nevada, and the creation of a strategic lithium reserve. But as CNBC experts noted, these projects could take years to bear fruit, while the crisis was unfolding now. The shockwaves quickly spread across Europe. In Berlin, German officials convened emergency meetings to address fears that their German auto industry, heavily reliant on Chinese materials, could collapse within months. The head of Germany's Automobile Manufacturers Association warned that without Chinese lithium and magnesium, Europe's industrial machine could grind to a halt. Meanwhile, inside China, state-run media unveiled the slogan, "Made in China for China," signaling a decisive pivot towards self-sufficiency. Beijing announced 1 trillion yuan in new funding for domestic microelectronics and rare metal refining, preparing the economy to stand alone if necessary. In Washington, policymakers considered an even more drastic step, a comprehensive ban on dual-use technologies exported to China. That would include artificial intelligence, quantum computing, and advanced simulation software. Experts compared the potential impact to the 1970s oil crisis, warning that the global economy could fracture into two rival blocs, one orbiting around Washington, the other around Beijing. Multinational corporations were already responding, building two parallel supply chains, one for the US, one for China. The efficiency that once defined globalization was giving way to duplication, division, and rising costs. Amid the escalating confrontation, US allies faced mounting pressure to choose sides. In Ottawa, Prime Minister Carney confirmed plans to re-engage Beijing after years of frosty relations, even as Canada's own trade tensions deepened. Negotiations centered on potential tariff relief for Chinese electric vehicles in exchange for restored access to the Chinese market for Canadian canola. Behind the scenes, Canadian and U.S. officials were also working to defuse disputes over steel, aluminum, and energy. Yet despite diplomatic reassurances, Canada's auto sector was already feeling the strain. Stellantis announced a major shift of production from Ontario to Illinois, a move that stunned Canadian leaders and underscored the harsh realities of the new trade order. As the crisis unfolds, one question looms over the global economy. How long can this confrontation continue? China's growth is slowing, yet its alliances with Russia, Saudi Arabia, and the BRICS bloc are deepening. More than 30 nations are preparing to use the yuan and ruble in energy trade, a move that challenges the US dollar's dominance for the first time in decades. Meanwhile, beneath the ongoing rhetoric, trade between China and the United States quietly continues. Ships still sail, contracts still sign. But beneath that surface calm lies deep mistrust. Many now fear the world is entering a new economic Cold War, one where technology, trade, and geopolitics have fused into a single global struggle, and neither side shows any sign of backing down.